You open the app, 7 a.m. Market's been open 23 minutes. Your portfolio is down 4%. No news, no earnings, no announcement. The number is just smaller. You close the app. 8 minutes later, you open it again. Still down, phone face down on the table. You make coffee. You try to identify the feeling in your chest. You decide it's hunger. You know it's not hunger. This is Tuesday. You are always last. There is a building in Mahwah, New Jersey. Inside it, hedge funds pay millions per year to physically house their servers in the same building as the NYSE exchange computers. Not near it, inside it. The sole purpose, shave microseconds off trade execution. Microseconds. Nobody mentioned this building when you opened your brokerage account. The welcome email had a smiling person in a sunlit kitchen. It talked about empowering individual investors. While you were reading it, an algorithm executed 14,000 trades. You read an article on a Tuesday morning, a company clicks. The growth is real, the product makes sense. You buy. Here is what happened before your finger touched the screen. An analyst covered that company 6 months ago. His fund built a position slowly, carefully without moving the price. A journalist got a tip and wrote the article you just read. Before it published, someone who knew it was coming bought more. The article goes live, retail attention floods in, the price moves on your order, and 10,000 others just like it. All reading the same article, all feeling the same click of recognition. The fund that spent 6 months building that position sells into your excitement. You are not an investor in this transaction. You are the exit. You will never know it happened. The stock might keep going up, it might not. But the information hierarchy, who knows what and when, is built in a direction that is permanently, structurally, legally against you. Michael Lewis documented this in Flash Boys in 2014. Nothing changed. The players got faster. The building in New Jersey got more expensive. You are still in the sunlit kitchen. The market closes. Small loss today. Nothing catastrophic. At 11 p.m., you are still running the numbers in your head. Your brain, the same hardware that kept your ancestors alive on the African savanna for 200,000 years, is now managing your stock portfolio. It is doing this with the same toolkit it used to avoid predators and find food: threat response, loss avoidance, catastrophically wrong tools for financial markets. When your portfolio drops, your amygdala fires, danger signal, loss of resources. The exact neurological response that made your great-great-grandmother sprint from a predator now makes you sell your best position at the bottom of a correction. The feeling is identical. Your brain does not know the difference. When your portfolio goes up, dopamine floods in, you feel like you've figured something out, so you add more. At the top, right before the reversal, buy high, sell low, buy high again, sell lower. Daniel Kahneman spent his career documenting exactly this. His research showed that losing $1,000 feels roughly twice as painful as gaining $1,000 feels good, which means every time your portfolio moves, you're experiencing the losses at double the intensity of the gains. You are running an operating system permanently calibrated toward panic. And you know this. You've read about it. It doesn't help. The knowledge sits in your prefrontal cortex while the panic fires somewhere older and faster. By the time your rational brain assembles a coherent argument for holding, your thumb has already hit sell. And the truly insidious part, you will construct a perfectly logical explanation for why selling was the right decision. You're not just irrational, you are irrational in a way that feels completely rational from the inside. You lie awake, tomorrow it might be smaller again. You tell yourself you'll check in the morning, you check at midnight. February 2020. You bought Tesla in 2019, not because of Reddit, not because of a tip, because you watched the product for years. You drove one. You understood that the internal combustion engine was a technology on its way out, and one company had a decade head start. The factories, the charging network, the software, the battery chemistry. You did the work. You read the filings. You made a real decision based on a real thesis. Then February 2020. COVID arrives, the market cracks, Tesla drops from roughly $180 to under $80 in weeks. More than half your position gone, not because the thesis changed, not because electric vehicles stopped being a good idea, because the entire world repriced simultaneously in a direction nobody had a model for. The news is apocalyptic. Serious people in serious suits are using words like unprecedented. Some are saying this could be worse than 2008. Nobody is saying buy more Tesla. You open the app, And here is the moment. Not dramatic, quiet. You alone, phone in hand, looking at a number that represents months of your salary, cut in half, on a Tuesday morning, with no clear end in sight. Your brain is not offering you two financial strategies. It is offering you two versions of yourself. One version sells, stops the bleeding, calls it protecting capital, plans to buy back when things stabilize. The other version closes the app, makes coffee, goes to work, buys more at $80, because the thesis hasn't changed. The world is still going to stop burning gasoline, and this price is a gift from a panic that has nothing to do with the long-term story. The first version watches Tesla hit $400 by the end of 2020. Split adjusted, over $1,200 in early 2021. Watches from the sideline. Looks for a re-entry point that never feels right, too high, then too uncertain. Then a new crisis arrives, and it's too risky again. He never gets back in. He still talks about Tesla, how he saw it early, made money on it before things got crazy. He leaves out the part where he sold at $80. The second version doesn't feel like a genius. He feels like someone whose stubbornness happened to point in the right direction. He still checks the app too often, still has nights where the number feels too small. He just didn't sell. That is the only difference. He just didn't sell. There is a specific pain that should have a clinical name. It doesn't. It is the feeling of watching a stock you sold go up without you. You owned it. You had a reason to sell. The drop was unbearable, or the gain felt unreal, or someone made a convincing argument that the thesis was broken. You sold, you moved on, then it went up. Not a little. Significantly. The kind of up that reshapes a portfolio. You track the price even though you no longer own it. You calculate what the position would be worth today. You do this more than once. More than you'd like to admit. Behavioral finance calls the underlying mechanism the disposition effect, the tendency to sell winning positions too early, to lock in a gain, and hold losing ones too long to avoid making the loss official. The result is a portfolio that slowly empties of your best ideas and fills with your worst. But the ghost isn't just the financial number, it's the judgment. When you sold, you made a call, you assessed the situation and concluded the story was over, and the market spent the next 2 years proving that assessment wrong in the most visible, daily updated, numerically exact way possible. Some people sell Apple in 2013, Amazon in 2016, Tesla in March 2020. The ghost of what they sold keeps compounding. Quietly, without them. Every day the gap widens. The number they calculate in their head gets a little larger. You never fully stop tracking it. That's the thing nobody tells you. You sell the position, you don't sell the ghost. The ones that are truly unbearable aren't the stocks that cost you money. Those hurt. But you can build a story around them. Bad luck, bad timing, information asymmetry. There are ways to carry a loss that preserve your sense of competence. The unbearable ones are the ones you knew about, watched, almost bought, said out loud to another person that this company was going to be enormous, and then didn't buy. The year is 2010. You know Amazon. You use Amazon. You've said it. This company is going everywhere. Bezos is building something with no natural ceiling. You use it to buy books, then electronics, then everything. You can see what it is becoming. You didn't buy. Maybe it felt too expensive. Maybe you were waiting for a dip that never arrived. Maybe someone told you the margins were terrible and a company that doesn't make profit can't sustain its valuation. Maybe life just got in the way. Amazon in 2010 was roughly $135 a share. Adjusted for the 2022 split, the equivalent today is over $3,500. Now do it with Apple, with Netflix, with Nvidia, a company that made graphics cards for gamers that turned out to be the exact hardware required to run the artificial intelligence revolution. Nvidia in 2015 was under $5. Post-split, it crossed $140 in 2024, the pre-split equivalent of over $1,400. These were not hidden companies, not obscure bets requiring specialized knowledge or privileged access. They were in your pocket, you used their products every single day, you could see what they were doing, you could feel the direction they were moving. The cruelest trick the market plays on retail investors is this. It makes the most obvious, accessible, life-changing opportunities available to everyone, and then constructs just enough psychological friction to ensure almost nobody actually acts on them and holds long enough to capture the return. The information was never the problem. You had the information. Buying the shares and leaving them alone for a decade, that was the problem. That is still the problem. It will always be the problem. You turn on financial news. A man in a very good suit is telling you with complete confidence what the market is going to do next. Specific number, specific time frame. 3 reasons delivered quickly in the tone of someone describing something that has already happened. He is wrong. He has been wrong before. He will be wrong again. He will be back tomorrow with something new that is also wrong. And the channel will present him with the same graphics and manufactured gravity because his accuracy is not what he is being paid for. CXO Advisory tracked the predictions of 68 financial gurus over multiple years. Average accuracy, 47%, slightly worse than a coin flip. The market for confident wrongness is apparently inexhaustible. Financial media doesn't make money when you make good long-term decisions. It makes money when you watch. You watch when you're scared. So the entire architecture of financial news is built around manufacturing and maintaining your fear at a precise calibration. Frightened enough to keep watching, not so frightened you turn it off. Tariffs, recession, rate hikes, bank failures, AI bubble, China, the Fed. There is always something. The something changes. The fear level stays constant. That is not a coincidence. That is the product. And every time you react, every time you move to cash because a pundit said the crash is imminent, every time you sell because a headline felt too heavy, you pay. Not a charge on your statement. You pay in the slow, invisible compounding cost of not being invested during the recovery that follows every single thing you were afraid of. 2011, European debt crisis. 2015, China slowdown. 2018, trade war. 2020, pandemic. 2022, inflation and rate hikes. 2023, regional bank collapse. The market recovered from all of them. The news never told you it was going to. That's not what it's for. You turn off the news and open your phone. There is a man with 300,000 followers who found a small cap stock going to 10 times. Proprietary research, extremely excited, bright yellow thumbnail, 3 exclamation points, posts every single day. He bought 6 months ago. He is selling into your attention right now. The content is the distribution mechanism for the pump. The dump was always part of the plan. In 2024, the SEC charged multiple influencers for coordinated pump and dump schemes running through social media at a scale that wouldn't have been possible before smartphones put a brokerage account in every pocket. The settlements were significant. The damage to retail investors was larger. The next version of the scheme was already running before the ink dried. Then there is the options trader. Made $80,000 last month. He has screenshots. He will teach you his exact system for $997. What the screenshots don't show is the $300,000 he lost the 4 months before that. The course is the business. The trading performance is the marketing material for the course. And then there is the third type. No malice, no scheme. Just a person who confused a bull market for skill, built an audience, and now cannot be publicly wrong without losing the thing that gives his life structure. Every bad call becomes a temporary setback. Every missed prediction gets quietly deleted. The next call arrives just as confident as the last. These people are more dangerous than the pumpers in one specific way. The pumpers want your money directly. These people want your conviction. The moment you outsource your thesis, the moment your reason for holding something is someone else's belief rather than your own understanding, you will sell the second their confidence wavers. The loneliness, real conviction, the kind that lets you hold through a 50% drawdown, the kind that makes you buy more when everyone around you is selling, cannot be borrowed. You cannot hold Tesla at $80 in March 2020 because a YouTube channel told you to. You will sell the moment the channel changes its mind, and channels respond to sentiment. And sentiment in March 2020 was the end of the world. To hold through real pain, you have to have done the work yourself. You have to understand the business at a level where the price becomes almost a separate conversation from the thesis, where a 40% drop is new information you evaluate against what you already know, not a verdict you accept. And when you have that level of understanding, almost everyone around you thinks you're wrong. Your family thinks you're in denial. Your colleague asks if you've considered that you might be too attached to be objective. The friend who sold at $80 says he'll buy back when things settle. The financial consensus, the thing that sounds reasonable and feels safe, is built almost entirely around what has already happened. The opportunity is always in the thing that hasn't happened yet, which means real conviction, by definition, requires being early. And being early is experientially indistinguishable from being wrong until the moment it isn't. The loneliness is not a side effect of the strategy. It is the strategy. The edge exists precisely because most people cannot tolerate it long enough to collect it. Say you hold. You survive the volatility, the noise, the loneliness. You're still bleeding from cuts you can't see. Every time you sell a position held less than a year, short-term capital gains tax takes up to 37% depending on your bracket. The investor who never sells defers this bill indefinitely. The active trader pays it every year, on every gain, compounding the loss of compoundable capital in a direction that is silent and permanent. An actively managed fund with a 1% annual expense ratio sounds nearly irrelevant. Over 30 years, on a $100,000 investment, the difference between 1% and a 0.03% index fund costs approximately $200,000 in lost returns, not because the fee takes 1% of your money, because it takes 1% of the compounding every year. As your portfolio grows, the dollar cost grows with it. Then inflation. Your cash sitting in a current account earning 0.1%, while inflation runs at 3%, is not standing still. It is losing purchasing power every single day. Silently. Without a single trade, without a single bad decision. The retail investor who doesn't understand these three mechanisms isn't just failing to grow money. They're actively, measurably, mathematically losing it. Every day, without doing anything wrong. March 2020. Portfolio down 40%. You know the history. You know markets recover. You've read about 2008, 2001, 1987. Every time recovery, every time new highs. You know this the way you know that smoking causes cancer. Completely, intellectually, with full access to the evidence. You can't sleep. 3 a.m. The scenarios run without your permission. What if this time is different? What if the recovery takes a decade? What if the thesis is wrong and you haven't admitted it yet? By 4 a.m., you've decided to sell. Not because anything changed, because the feeling became unbearable, and selling is the only available action that makes it stop. This is the first break. June 2020, 3 months later. The market has recovered most of the loss. You're sitting in cash, waiting for the right moment to re-enter. You tell yourself you'll buy the next dip. The dip doesn't come. The market keeps going up. Buying back in now means paying more than you sold for, which feels like admitting you were wrong. So you wait. The waiting becomes its own position. The cash becomes a commitment. The story you tell yourself about why you haven't re-entered gets more elaborate and more convincing the longer it goes on. 2 years later, you've stopped calculating the gap between where you sold and where it is now, because calculating it hurts too much. The market didn't test your conviction once. It broke you twice, in completely different ways, 6 months apart, using completely different psychological mechanisms. That is what it actually does. The speed advantage of institutional money over yours is not narrowing. It is widening as the technology improves, and the capital that funds it compounds. The psychological vulnerabilities, loss aversion, the disposition effect, recency bias, are not going to be educated away. Reading Kahneman does not rewire your amygdala. Financial media will not stop manufacturing fear because fear generates attention, and attention is the product. Social media will not stop hosting schemes because engagement matters more than accuracy. The tax code is not written for you. The fees of most financial products are not designed in your interest. The information hierarchy of the market is permanently, structurally, legally tilted in a direction that is not yours. You are a retail investor. You came in last. Least information, least capital, least speed, a brain actively working against you in ways so systematic and predictable that an entire academic field exists just to document them. And here is what you have that none of them do. Time, not motivational time, not play the long game time, structural, concrete, computable time that the people on the other side of your trades are legally and professionally prohibited from using. The hedge fund manager needs to beat the market every quarter, not every decade, every quarter. Or his clients leave and he loses everything. He cannot hold through a 40% drawdown because his investors will pull their money before the recovery arrives. He cannot concentrate in 5 positions. He cannot ignore macro noise. His entire professional existence is a set of constraints that make long-term thinking structurally impossible. You need to be right once about one thing over a long enough period that the compounding does the work. Find a company selling something real to real people that more people will want in the future. Understand it deeply, not the ticker, the actual business, the competitive position, the direction of the market it operates in. Deeply enough that you can hold it through the moments when the price says you're wrong and everyone around you agrees with the price. Buy it every month. Same amount, not when it feels right. Every month. Because the months when it feels most wrong are often when the price is most in your favor. Don't sell unless the business itself fundamentally changes. Not because the price dropped. Not because a headline scared you. Not because a pundit made a compelling argument at 11 p.m. Unless the actual business, what it sells, who it sells to, why people choose it over alternatives, unless that changes, the price is noise you're choosing to interpret as signal. That's it, the complete strategy. The institutional investor cannot execute this. His constraints are your advantage. His quarterly pressure is the thing you weaponize by doing nothing. His compulsive activity, justifying his fee, demonstrating value, showing clients he's managing risk, that activity is the mechanism that transfers money slowly and consistently toward the person who sits still long enough to receive it. Buffett said the stock market is a device for transferring money from the impatient to the patient. He was not being poetic. He was describing the actual mechanism. The transfer is happening right now. Every day, the only question is which side of it you're on